This lecture provides an introduction to economic uncertainty. A large telecom supplier, Teleswitch, sold its product only through distributors. And in 2000, some of Teleswitch's largest customers came to the company wanting to cut out the middleman. They wanted to avert the distributor and deal directly with Teleswitch. Now, Teleswitch had a decision that they needed to make. Either go along with the wishes of their largest customers and risk alienating the distributors, or continue to sell through the distributors and risk losing some of their largest customers. There was a lower probability in Teleswitch's estimation of losing their distributors because the distributors would have incurred pretty sizable costs if they switched to a different telecom company. But if they lost those distributors, Teleswitch reasoned, it would have a much larger impact on their overall profit. And this type of problem illustrates what firms deal with every day when they make decisions under situations of economic uncertainty. And in this lecture, we'll talk about how to quantify and deal with this type of economic uncertainty. So if we think about Teleswitch's decision, their decision was really to deny the request and risk losing the large customers, which they determined was a relatively high probability or higher probability but low cost event, or approve the request and risk losing the distributors. A big deal if it happened, but relatively unlikely. And so let's talk about how we want to frame decisions like this. When you're uncertain about the costs and benefits in an economic decision, you replace those costs and benefits with expected costs and expected benefits. In this lecture, we'll talk about how to deal with uncertainty in pricing. When customers have unknown values, then you face a familiar trade-off. Price high and sell only to the high-value customers, or price low and sell to all customers. Not knowing the values of customers adds a wrinkle, but if you can identify or at least quantify the range of values, then price discrimination becomes a viable option. You can sell at one price to the higher value customers and at a lower price to the low value customers. The Teleswitch problem illustrates the type of uncertainty that exists in most business decisions. And this lecture looks at ways to model uncertainty to arrive at decisions that will best profit your firm. So we're going to focus on modeling uncertainty, and in doing so, learn to make better decisions, identify the sources of risk in a decision, and compute the value of collecting additional information that might enhance your decision-making ability. To model uncertainty, we use a random variable. A random variable is defined as a way of representing numerical outcomes that occur with different probabilities. To represent values that are uncertain, we list the possible values that a variable could take first. Second, we assign probabilities to each value. And then third, compute an expected value by calculating a weighted average. Most of the examples in this lecture will deal with either binomial or trinomial random variables. Let's talk first about a binomial random variable. A binomial random variable is a random variable that can have two values, which we will represent with x1 or x subscript 1 and x2. And each of those values occurs with a certain probability. The value x1 occurs with a probability of p, and the value x2 occurs with a probability of 1 minus p. So the probabilities sum up to 1 or 100%. The expected value of the x variable in this case is equal to a weighted average of the two possible outcomes. The probability of the first outcome p times the value associated with that outcome, x1, plus the probability of the second outcome, 1 minus p, times the value x2 associated with that outcome. A trinomial random variable is essentially the same with one wrinkle or one additional twist. We have three values that the variable can take, which we will call x1, x2, and x3. The probabilities we will define as p1 for the first value, p2 for the second value, and 1 minus p1 minus p2 for the third value. Here again, then, we can see that if we add up all three probabilities, they'll sum up to 1, or 100%. Again, the expected value is simply a weighted average, the probability of each outcome times the x value associated with that outcome. Let's look at a simple example, a game known as Wheel of Cash. This game costs $50 to play, and the carnival wheel is divided like a pie into thirds. One third consists of a $100 prize. So we can imagine spinning this wheel. If it lands on 100, you win $100, 75, and $5, you win those amounts. Now, it costs $50 to play one time or one game or one spin of Wheel of Cash. Should you play? Would you play? We can analyze this actually from the perspective of a probability theory, because what's uncertain here is the amount you'll win. You know it costs $50 to play, but we can calculate the expected value of playing this game assuming a fair wheel. Assuming a fair wheel, which means each outcome occurs with an equal probability of 1/3, the expected payoff is the probability of each outcome, which is 1/3 for all three outcomes, times the value associated with that outcome. We see here that the expected payoff is $60. If this was a fair wheel, economically it would make sense to play this game because your expected payoff exceeds the cost of playing. Now, it's worth mentioning and noting that you would actually never win exactly $60 for any one spin of the wheel. 2/3 of the time you would win more than it costs to play. 1/3 of the time you will win or earn $100. Another third of the time you'll earn $75. But then the last 1/3 of the time you'll lose a lot of money. You'll make $5, but remember, this costs $50 to play. And so in that last 1/3 of the time, you'll actually net out losing $45. But on balance, expected value analysis helps us to weigh the expected costs and the expected benefits, and in this case, the expected value or payoff, $60, exceeds the known cost of $50, and on average, this would make economically good sense to play this game. But what if the wheel was biased towards the $5 outcome? As it would be at most casinos, probably. What would the expected value be then? Well, we can actually quantify the magnitude of that bias and factor that into our decision making. In this case, we can recompute the expected value using the probabilities 1/6 and 1/6 for the $175 outcomes and 4/6 or 2/3 for the $5 outcome. We see here now the expected value has dropped almost by half, down to $32.50. At this point, or with these probabilities, a wheel tilted in favor of the $5 outcome, it makes no economic sense to play this game. Let's go back to the teleswitch decision and look at it using uncertainty analysis. What we'll see here is that this is actually a pretty close call. If you look at the extensive tree form diagram, it's a little bit different from what you might see in a game theory setting just because we've drawn straight lines and boxes, but the idea is exactly the same. The left-hand side of this switch or of this diagram deals with the decision that telecom might sell only to their largest customers. In other words, cutting out the dealers. Now, the lower two nodes or boxes show what might happen and what the probabilities are if the distributors decide to stay with Teleswitch, even though Teleswitch has cut a deal on the side with some of its largest customers, or if the distributors decide to find a different firm to do business with. The lower left box deals with the latter scenario. The distributors leave. You can see it's a relatively low probability event. The probability is only 0.2 or 20%, but the profitability is $30 million compared to, look to the box just to the right of that, if the distributors stay, which has a probability of 1 minus 0.2 or 0.8, Teleswitch earns $130 million. So you can see, even though it's a low probability event that the distributors leave, the economic magnitude is quite large. On the right-hand side of this tree, we see the opposite decision that Teleswitch can make, and that is to deny the request of their large customers and continue selling only through the dealers. Now, here, the large customers may remain, they may continue purchasing through the dealers, or they may defect. The probabilities in the lower right two boxes illustrate the likelihood of each of those two events. And what we see is that the probability that the large customers leave is 0.6 or 60%. The probability that they stay is 40%. Teleswitch's profit, if they leave, is somewhat reduced down to $100 million. If they stay, we've got the $130 million. So you can see that as we go along from left to right along the bottom boxes, the second box and the fourth box have the same level of profit, $130 million, because both of those correspond to the situation that the large customers remain and Teleswitch continues to sell, or the distributors remain or the customers remain and nobody defects, So now we can look ahead and reason back. We've analyzed that last stage, including the probabilities and the payoffs. Now let's go back up a level and calculate the expected profit from each scenario. On the left-hand side, which corresponds again to the decision that Teleswitch might make to abandon its distributors and sell directly to the large customers, the expected profitability is equal to the 20% probability that the distributors leave times the profit, $30 million, plus 80% probability that the distributors stay times $130 million. We see that's $110 million of expected profit. By the same calculus on the right-hand side of the chart, we can see that if Teleswitch continues selling only through the dealers, their expected profitability is $112 million. This balances off the economic magnitude of losing money through one of the two defections with the probability that each of those events occur. It's a close call, but it looks like Teleswitch would be better off continuing to sell only through dealers and risk the loss of some of their large customers. Now, because it's so close, it would also suggest to us that Teleswitch might benefit from investing in some additional information. These probabilities, as you can see, are very rough and crude estimates. And because the decision is so close, if Teleswitch was even able to improve the estimation of those by a small amount, it might greatly impact their ultimate final decision. Let's turn our attention to another example, a classic example of an incumbent monopoly firm faced with the possibility of a new entrant. The new entrant knows that if they enter the market, there are two fundamental choices the monopoly firm can make. They can acquiesce or accommodate the new firm, or they can engage in a costly price war and try to drive the new entrant from the market. Let's assume that the probability of retaliation, a costly price war, is estimated to be 50%. The new entrant then is faced with, in this extensive diagram, extensive form of the tree, a decision to enter or remain out of the market. Now, on the right-hand side, if they remain out of the market, it doesn't really matter whether the incumbent firm would have retaliated. We'll never know what didn't happen. And in this case, the new entrant firm will simply earn zero profit because they've stayed out of the market. The left-hand side is a little more interesting. We see two splits, a 50-50 split representing the probability that the incumbent firm will fight or retaliate or accommodate. The key number here then that goes along with that probability is the accompanying profit for the new entrant firm. If you look down at those numbers, you can see that the profitability associated with entering and having the incumbent pricing high or accommodating is $60 million versus a $40 million loss if the new firm prices low and engages, or excuse me, if the incumbent firm prices low and engages in a price war. The expected value, the probability of each event times the payoff in each event, actually turns out to be a positive 10%. Excuse me, positive $10 million. But we can also think about the percents in this problem. They've been given to us here, but it's also very interesting and useful, say if you're the incumbent firm, to ask the following question. What is the highest probability or the most likely that the monopoly incumbent firm could be estimated as engaging in a price war and still make this a profitable entry? In other words, how high could that probability of retaliation go before I want to stay out of the market and it changes my decision? So finding that break-even probability is a very economically useful event, and it can be done simply by trial and error or some algebra manipulating this formula to look for or solve for what that p-value or probability needs to be to make this just a break-even proposition. Uncertainty in pricing arises when the demand for a product is unknown. To model this type of uncertainty, we classify the number and type of potential customers. For instance, if we had high-value customers who were willing to pay $8 and low-value customers willing to pay, say, $5, and let's suppose there were equal numbers of customers in our customer group, we could model this or approximate this by simply assuming 2 customers, 1 of each type, or a probability of 50% for each type. Now, what would be the optimal price in this situation? Well, to answer that, we can incorporate our uncertainty about the type of customer into an analysis such as the one we've been doing. Let's make a further assumption, and that assumption is that the marginal cost of this product is $3. That's an essential piece of information if we're trying to determine the optimal price for the product. Now, by pricing high, you would earn $5, the 8 minus 3, on each sale when you sell to a high-value customer, but that only occurs 50% of the time. On the flip side, if you price low, you'll earn less, 5 minus 3, or $2 per sale, but you'll sell to every customer in the market 100% of the time. Now, we can analyze this, again, by incorporating our uncertainty about the customer type into this particular uncertainty tree. If you price high, you can see on the left-hand side of this tree, you may get a high-value customer 50% of the time. You may get a low-value customer. The profitability is $5 and 0 for each of those scenarios, and the expected value, looking ahead and reasoning back, is equal to $2.50 when you price high. Pricing low, the right-hand side of this tree, shows us that you'll make a sale every time, 100% of the time, and every time you make that sale, you'll earn $2. So your known profit when you price low is $2 even. Especially if you're in a repeated game situation where the law of large numbers or the law of averages will likely kick in, you want to go with the outcome that has the higher economic expected value. In this case, $2.50 or pricing high. So when it comes to price discrimination, the key idea is to identify the 2 types of customers, set the prices different for each group, and prevent arbitrage between them. If you can do these things, then you can price discriminate. In our example, if you're able to price discriminate, then you could actually improve upon that expected profit of $2.50 by finding a way to sell for $8 to the high-value customer and for $5 to the lower-value customer. Thanks for listening to this lecture on economic uncertainty.